Okay, I am excited to invite a guest here. So, Joe, why don't you introduce yourself and what you do for us at Illuminate?
Sure, happy to do it. Thanks for having me, Ben. My name is Joe Cortese. I'm a partner with Fiducient Advisors, and I'm one of the leaders of our outsource investment research practice, which is where we partner with firms like Ben's, and we deliver all of the intellectual content and capital that my firm has created over our 30-year history. And we provide that to other firms on an outsourced basis to help support their investment efforts. So this is everything from asset allocation, investment research and selection. We do a tremendous amount of research. We have 40 analysts that participate in our investment research effort. And so we're able to leverage the great work that these folks do to support Ben and his team in the portfolio construction and investment selection efforts, as well as distributing a lot of content that's useful throughout the investment process.
Yeah, Joe, I think is underselling how important their team is for us, and just Joe's brilliant and has a lot of great insight. And I thought it'd be great to not just have us kind of in our calls that we have talking about things behind the scenes, but to expose some clients to what you guys are able to do for us. So I'll let you kind of walk through the core, year to date and what's going on and where we are in the markets, and we can go any direction you want to go.
Sure. The good news is things have been generally positive so far this year, as I think most people are aware. Last year was a difficult year, both on the fixed income and equity side, with markets going down in tandem, and that's a very unique outcome. Frankly, it has not happened very much at all in the modern era of investing, but it's as a result of the Fed really embarking on what has been the swiftest interest rate tightening cycle of the last 40 or 50 years. And we all know that the Fed needed to raise rates to rein in inflation. And so they've done that very quickly. And the good news is it appears that we're in the latter innings of this tightening cycle. The Fed paused last month in June, did not increase rates for the first time this year. The market does expect that the Fed will increase rates one more time, at least this year, this month in July, and then probably take another pause. But as I said, despite that, markets have done relatively well so far this year. You've got, sort of core fixed income up a couple percent this year, which is good. Riskier areas in the bond market, like high yield, up 5% for the year. Equities have had a really strong year, particularly U.S. large cap equities, up 16, 17% through the last few days here. Even non-U.S. assets, as some people would be surprised to learn, international equities are up 12% or so. With everything going on in Europe and outside of the U.S., I think folks may have a more sort of dire view of what's happened. But despite all of that, those markets have also been relatively strong. The only really weak point we've seen in markets this year is within commodities, and particularly energy. And frankly, though we don't like to see negative returns out of that particular part of the market, that helps us all in the pocketbook, right? We pay less for energy. It helps obviously get control of the inflation situation, and so that's been the one weak spot thus far in financial markets. But I'd say on balance, we'll take it, knowing that everything else is done relatively well.
Yeah, absolutely. I think people are happy. Inflation's not as high as it was, and you're seeing it kind of flow through everything. You mentioned the Fed and Fed funds rate and things like that. I'm actually going to share my screen, have you kind of walk through and what this means for bonds kind of going forward. So give me just a second. Okay, I think you can see our little chart. This is actually from the mid-year outlook that we just posted, actually, but I know you created this, so
Yeah, exactly. So if you look at the fixed income markets today, the yield curve is inverted. So what do we mean by that? We mean that shorter term rates are higher than longer term rates that are available in the marketplace, and that's unique. Typically, the yield curve is upward sloping. Short rates are typically lower than long term rates, and you get this nice sort of curve. But that's not the case today because the Fed has raised interest rates on the short end so fast. And so we get questions from clients, well, why don't we just be in cash and get money market rates, which are 4.5%, 5%, and higher than bond rates right now in many cases? And that is correct. But so what we looked at here with this chart is we said, okay, after the Fed cycle peaks, when the Fed sort of has raised rates as high as they're going to raise them, and then they're stable, what do returns look like going forward? And as you can see, in the periods that we've highlighted here, cash is the worst performer once the Fed interest rate cycle has peaked. So yes, it's difficult going through the cycle, but once you get to the end of the cycle, you want to be in bonds. You want to be in short and intermediate term bonds, because that's where the return is going to come from. Obviously, as yields are higher, that's going to accrue to portfolios on a go forward basis. So if you look at the probabilities, if you look at what's happened in the past, it makes the case that we want to continue to hold bonds and portfolios versus trying to time, hey, let's get into cash and then we're going to time it and go back to bonds and back and forth. And we all know that trying to time markets is really a fool's errand.
Yeah, I think that's really good. We've had a little bit more cash just for clients as they move money around and things, and not, buying the individual bonds as quickly. But at this point, I mean, a lot of clients have seen us buy bonds in the portfolio recently. Just you've got the cash, and now it's time to kind of shift out of the super defensive. Let's just be really liquid. It was nice. It's nice to get higher rates, but as you talked about, it's better, better to actually be invested.
That's absolutely right, and it's okay to hold a little bit of cash. No issue there. I mean, particularly in this environment where you're getting paid to hold that cash, maintaining a little extra liquidity on the sidelines. I mean, that's completely reasonable. But the point is, we don't want to completely jettison our allocation to fixed income. That would be the wrong move. And even if you look at what the financial markets are telling us, they're still pricing in Fed rate cuts as early next year, maybe even before the end of the year. Now, I don't know that that's actually going to happen, but that's just what the markets are saying. So there again, which is why you would want to continue to hold bonds in the portfolio, because they would benefit from a appreciating price standpoint if and when the Fed does need to cut rates in the future.
That's great. I want to shift to stocks a little bit, both kind of as we look ahead. You talked about what's happened. Any thoughts looking ahead? I know you don't have a crystal ball.
Yeah, well, it's always dubious trying to forecast performance in terms of what's happening in the equity markets. But I would say the first observation is that it's been surprising how strong U.S. equity markets have been this year. I would remind folks that we haven't gotten back to the high water mark that we hit at the end of 2021. So we're still below those recent high levels. And so that, I think, is what's in large part propelling the bounce back here, is that as financial markets do, they typically overshoot in both directions. So we probably got way too high in 2021, and we got too low in 2022. And so now we've seen a nice snapback rally here. I would say if you look at some valuation metrics, though, they've crept up. They've crept higher. Valuations have crept higher this year. We're sort of at the top end of the 15-year range from a price to earnings, or PE standpoint, if folks are familiar with that term. And so, that makes us think that, companies need to earn a lot more in order to justify those valuations and continue to propel the equity markets forward. And we're now entering the second quarter earnings season. And I think it will be pivotal to see how companies do. Are they able to surpass earnings expectations, which frankly have been ratcheted down over the last few months? So the bar has been lowered, and can companies meet those expectations and maybe do a little bit better? If that happens, I think, we could continue to do okay from here. However, if companies don't hit the earnings expectations and they underperform, I think that could introduce some volatility into the equity markets in the back half of the year, because that would support the notion that things have gotten a little bit expensive this year. As we said, markets, equity markets are up 18% or so through the end of the week. So it's a pivotal point. In the next few weeks here will really give us some indication if we can continue to move higher from here, or if there's going to be a little downside volatility before, we get through all of this.
Yeah, I think a lot of clients see the prices go up, or they see the returns we show on our, client portals and things like that. And I think it's easy to miss, where's that actually coming from? You mentioned the valuations, the price earnings ratio. Prices are going up even if earnings aren't keeping up with it. And so that's where everything you described on the earnings is really important. I've got this question from clients for several years now. Why don't we just have everything in large cap U.S. stocks? It does better than international. It does better than small cap. Why don't we just load up on the 5 best names and move on? Any thoughts on that?
It's a good question. We get the question frequently as well. I mean, the shortest answer is there have been many periods historically where US large cap stocks have not been the best performer and over long periods of time. I mean, I think back to the early 2000s where international and emerging markets had outperformed US equities over a 10-year period, right? And correct, we haven't seen it since then. And you know, you could argue about the reasons for that, potentially what happened in the financial crisis and what you know, we've done since then. And no doubt, U.S. companies lead in innovation, and it's you know, one of the strongest, most efficient markets that's out there. But we would always advocate for broad diversification. I mean, first of all, US equities represent 60-ish% of the global equity market. So if you're not invested in non-US equities, you're just basically ignoring 40% of the overall market, which we don't think is a good idea. Also, then you go back to the valuation argument. International equities, emerging market equities, they're tremendously cheaper relative to US equities. So even if things look bad outside of the US and feel bad, it doesn't mean that those markets won't do better than US markets. And we just will never be able to time that. And then to your point, you know, the US markets have led for the last 13, 14 years. In financial markets, reversion to the mean is the most powerful force. And I have a hard time betting that the next 15 years for US equities will be the same as it's been for the last 15 years. I'd probably take the other side of that trade, if you will, and guess that non-US equities at some point, emerging market equities, will have their day in the sun again. And we're just not going to be able to time that. So we want to be fairly consistent with what global market capitalizations are in terms of US versus non-US. We want to lean into areas that appear more attractive from a valuation standpoint and those sorts of things. And so that's why we construct portfolios the way we do. We want to maintain those exposures. Sometimes it doesn't feel good, but it really is the prudent thing in portfolio management, investment oversight, maintain that broad diversification, because we will never be able to time it perfectly.
I think that was great. I think it's clear to everyone that we don't take these decisions lightly. There's a lot more that goes into it than just how do you feel about things, and it can feel difficult to or bad if you aren't invested in the things that are always the winners. But let's look at statistics and probabilities and all those things. I think if you go back to the beginning of the year, most financial, you know, market analysts were concerned about a bear market and things were going to be negative. And if you followed how you felt at that time, under weighted in stocks, and look how much return you would have missed out just so far this year. So it applies kind of across the board. Joe, thanks for taking the time. Anything you want to kind of add here at the end before I let you hop off?
You know, the only thing I would say is that you know, if you read the annual outlook we put out at the beginning of the year, collectively, the themes of you know, sort of markets bottoming out, continued volatility, all eyes on the Fed. Clearly, those themes continue to play out. We haven't mentioned the R word yet in this conversation, recession. I would say it does appear that the risk of recession, relative to your point, Ben, at the beginning of the year, has declined. Seems like the probability the Fed is manufacturing this soft landing that you may have heard about, the probability of that has actually risen, you know, throughout the year, and maybe we will get this sort of soft landing and be able to work our way out of this without getting into a full blown recession. But I think the three themes remain key. All eyes on the Fed. Looks like things are bottoming out here, but it'll take time, and expect volatility into the end of the year. It will not be straight up and to the right. Financial markets never are. And that's why we build portfolios that are broadly diversified, all weather. We'll get through these environments and we'll live to compound again in the future.
I think that's great. Thanks for joining us and taking the time.
My pleasure. Happy to do it. Thanks, Ben.
Well, we're back, and we've got another guest now. Gary, why don't you introduce yourself?
Well, I am Gary Bowyer. For those of you who don't know me, I started my firm about 36 years ago or so, and built the firm up and then sold it to Deerfield Advisors about 13 years ago. And at that point in time, Ben joined me in the Chicago office, which was my old firm. And Ben and I have worked together for the most part for the last 13 years. I left Deerfield at the end of 2005 and became a shareholder in Ben's new firm, Illuminate. I'm a shareholder. I sit on the board, and Ben allows me to pontificate on economic things, investments, and so on. And so I think we've had a good partnership really over 13 years. And for the people that were clients of my old firm and are still around, I'm glad to be in front of you again. Since I last participated in this video conference, Shelley and I, my wife, have moved to Texas from Glenview, Illinois. And so we're enjoying today the 107-degree heat. And as long as my air conditioning continues to work, it doesn't bother me in the least.
So, yeah, that's why you're staying inside and we're recording, right?
Yes, exactly. We could be doing this on my patio, but I would be sweating profusely. And you all would be worried about whether I was going to make it through the video or not. But we just came back from a couple of weeks up in Door County, Wisconsin, a week up there and a week in Chicago visiting old friends, and spent an evening having dinner with Ben, and all very enjoyable, but happy to be back home.
Happy that you don't have to have dinner with me again. That's what I heard.
Well, I enjoyed it. It was nice, and it was good, and we were able to catch up, and
that's right.
very, very good.
Well, I know you came prepared to talk about some stuff, and obviously this will be a good dialogue. And clients that have known Gary for a long time know that he has always been very interested in economics and markets and investments overall. And we talk, and now you just get to see part of that discussion that we would be having anyway. And so we wanted to record this and include you on here. So Gary, I'll let you kind of start wherever you want to go.
Well, where I'll start is the economics, particularly here in the U.S. and worldwide generally. It seems to be coming to a consensus of economists that we are going to have a very mild recession. The economy, although it's still doing reasonably well, there are some major parts of the economy that are in fact slowing down and give us some concern. I think we are going to have a recession. I think there's a possibility that it could be more than a mild recession, but the fact is, I don't know. And the real fact is, all of these economists that get paid to pontificate and tell us exactly what's going to happen, I don't think they really know any more than Ben and I know. And yeah, I think there's going to be a recession. I think it's a reasonable possibility that it will be pretty mild, but I don't think that that's baked in just because a majority seems to be of economists are saying that that's what it's going to be. I think you look at if we do have even a mild recession, given what the stock market has done year to date, NASDAQ up 36%, the S&P up 18.8%. That to me is saying everything is rosy. There's no bumps in the road. It's just straight ahead. And I have to say, I don't believe that. I think the market has gotten ahead of itself. What does that mean for the rest of the year? I think some caution is warranted, but at the same time, I don't think we're in for some, heavy downturn there. And, as all of you know, you're well diversified, and that's the whole point here. That even if the market does have a correction and it's a bit worse than I think Ben and I think that it could be, you're diversified. That's the whole point, that your whole portfolio isn't going to head into the tank because our equity allocation doesn't do as well. Certainly with the bonds, and we've been going a bit more into intermediate term bonds from just holding things in the short-term treasuries, which is absolutely the right thing to do as rates were going up, because we didn't take the losses in the bond portfolio by buying into 5% plus 6-month treasury bills. Boy, has that been a great way to be invested in bonds this year.
Absolutely.
And I think it's a better time to be getting into some intermediate term bonds, as Ben has been doing. So I don't know, Ben, you can chime in here.
No, I think if we go back to kind of, as you talked about, the recession or possible recession and where do stock markets go from here, I think it's really important as we talk to clients. There's really 3 ways you get return for stocks. So it's dividends, income that comes in. It's earnings growth. Earnings go up, companies make more money, and the price goes with that. And then there's a valuation change, the price people are willing to pay for those dividends and the earnings, and it's price multiples. And if you look at the actual returns US stock market this year, pretty much all of it has come from expansion of multiples, price appreciation, without the underlying, dividend growth and the earnings growth that are tied with that. And if you don't have growth in earnings, there really isn't a scenario long term that you keep going up at 18% for the S&P 500. At some point, you can't keep having that expansion. So, as you said, we need to see it with economic growth. And if you have a recession that goes the wrong direction, that's what kind of puts stocks in a precarious position. If things got worse than we expect, there's a lot of room to go down, even though we're not back to all-time highs that were set, 18 months ago.
Yeah, I am in complete agreement with that. I'll also talk shortly about a couple of our diversifiers that have definitely done their job. First one is gold. Gold has been a great investment the last couple of years, where it's really outperformed the overall market, especially in 2022. And although it's underperforming the market, it's still up, just as of this morning, up 5.3%. That's what a diversifier does. Sometimes it outperforms and helps the portfolio give us some alpha, and doesn't go up as much as the market. And other times, and I'll still take 5.3% on that portion of the overall portfolio. The second one, uranium. I am extremely bullish on the price of uranium over the next decade, because, as Ben has certainly talked to, I think, all of you about, that so many countries now realize, with trying to reduce the amount of the carbon footprint, the best way to do that is nuclear energy. And what's the base of nuclear energy? It's uranium. And so now the price of uranium hasn't gone up a whole lot in the last couple of years. And the biggest part of that is that uranium has been coming out of stockpiles, that the uranium mining companies, because they had to shut down, some of the biggest ones shut down, and so the utilities hadn't been buying uranium out of their stockpiles. Where it was coming from was other utilities, like the Japanese utilities when they shut down Fukushima, and they shut down all of their nuclear power. Germany done the same thing. Well, they were selling to other utilities around the world. Well, that's pretty much come to an end. And for example, Cameco up in Canada has just announced recently, I don't know, in the last 6 or 8 weeks, that they're going to start up their Cigar Lake uranium mine, which has been shut down for, I don't know, 4 or 5 years at least, because of demand. And the price since the beginning of the year of uranium, which has been around $50 a pound, 52, is now up around 54, got up to 56 a couple of months ago. It's come back down a little bit, but every month worldwide, you're seeing countries with starting projects for building new nuclear plants. And this is happening all over the world, including third world countries that understand that they can't be depending upon, I mean, coal is the primary energy source in probably many, if not most, third world countries, countries like Thailand, Malaysia, Eastern European countries, Romania, Bulgaria, among others, are starting to build nuclear power plants, as well as in the developed world. So uranium, I think, is a key part of the diversifier part of our portfolio. And I think the outlook is very, very good over the next decade.
Well, I think that point at the end is very important. That it's, over the next decade, we're not here trying to predict, okay, now's the absolute best time to buy, and here's the lowest point in the future. We have an intentional allocation to the space for clients. And if it pays off next year, great. If it pays off 8 years from now, great. The whole point is to have it from a long-term perspective, just like stocks. We have nothing in stocks that a client expects to need to pull out of a portfolio in the next 8 to 10 years. Same with some of these diversifiers and more opportunistic areas. And so I think everything that you're saying builds a great future. We just don't know exactly the timing of when these all would happen. And of course, nothing's guaranteed, but we're doing the best from a probability perspective we can.
Absolutely. I can't add much to that statement. That's the whole point. And I guess what I will say is, again, diversification. It works whether we want it to or not in any particular point in time, because you're always, with being properly diversified, you own something that's underperforming at any point in time. And that's really a part of the plan, because I don't know anybody, including Ben and I, that know everything that's going to outperform in any year and underperform. But we know with a well-diversified portfolio over a number of years, and that's what we're trying to do, is to get you folks to reach your goals over a number of years, and not just to, oh boy, we had a great this year. I'm really happy. Yeah, that's good, but that's not gonna happen every single year. We're trying to get you to your long-term goals, not just a goal for the next 6 months or year.
Right. Well, and you talked about the NASDAQ, and where I want to go next is kind of just technology and AI in general. But before we kind of move to your thoughts on that, I think it's important to remember, I mean, the NASDAQ is up a lot this year. It was down over 30% last year. And if you stuck with it the whole time, you actually still would be down from where it was. And it would look great on paper today, but it was awful last year. And if we can limit losses or limit the downside, you don't have to make as much on the upside. We've talked about that many, many times, but it's all part of diversification. If we can be well diversified, we never need to hit the grand slam home run. We can do a good job and be consistent and protect you on the downside. And you don't need the sky high returns when they show up. So, Gary, if you could talk about, a big part of so far this year, especially in the NASDAQ and U.S. stocks, is what I kind of want to call the AI bubble. Not that it's not reasonable that artificial intelligence is driving some of the returns, but it's human nature. We tend to get overexcited, overenthusiastic on things. I think back to when COVID happened and everyone bought companies like Zoom and Netflix and all the work from home and stay at home stocks that are now in major drawdowns. Since then, you go back to crypto and the blockchain and the excitement all about that we've seen multiple times. Now we're in what some people call the crypto winter, where things have gone probably too far the other direction. I think AI, you've got this over exuberance into what this could mean, and you're buying a lot of stocks that may or may not benefit. That doesn't discount the fact that there is positive changes and positive things that will happen in the long run, but it also you mentioned Nvidia before we started recording. Just the multiples that people are paying are kind of ridiculous from an investment perspective. So if you could both talk about the future of the technology and how you see it, but also maybe touch on, just because there may be a great technology or a great benefit that you see, that doesn't mean it's a good investment today to be over excited. There's a difference between a good investment and a good technology.
Yeah, several things on this. One of them was Ben and I were talking before we started the video here about NVIDIA. Great company. I mean, it is owning the market now on AI for the things that it takes to build it with the semiconductors. It's now selling for 40 times sales. I'm sorry, but that's ridiculous. Even though it's a great company, I would love to own it. Hey, but not at 40 times sales. I read an article the last couple of days about some of the high-tech darlings of the late 90s, Sun Microsystems and Oracle and some others. Sun Microsystems, of course, was taken over by another company at way less than 40 times sales. Oracle, that was up in that range, has still never gotten back up to that. And it's gone up a whole lot as a tech company. Microsoft took it over 15 years to get back to the price that it was at in 1999. Since then it's exceeded that nicely, but 15 years of really poor returns with Microsoft, that tells you that some of these high flyers now, again, they're great companies. I love NVIDIA as a company, but as a stock, I'll pass right today, because the market, as Ben has already pointed out, it can get overvalued, it can get undervalued. Although I love tech stocks with the future, but at 40 times sales, it just doesn't make sense. And along that same line, I am very optimistic about technology again over the next decade, and it doesn't have to be just AI. An area that hasn't participated at all, and I'm doing some research on, is in the area of biotech, pharmaceuticals, and so on. There are some great things happening there, but biotech stocks this year down, or excuse me, they're up about 1%. They were down last year quite a bit. Some things like gene therapy, and that are, you're starting to see some actual things coming to market where gene therapies can actually cure disease, not just to treat them, but actually cure them over the next decade. I think that's going to be great. Quantum computing, nuclear power, which we are invested in, fusion power, which is still way off in the future. I wouldn't try to invest in it, but I think there's great hope out there. And some things I think, in the coming year and years, Ben will be talking to you about, because we do think we have some chances to add alpha to the portfolio. But they'll be a small part of the portfolio, but we're looking for things like that. We continue to look.
Right. And just because we're not currently invested in something doesn't mean we're not optimistic about what that can mean, and what that could mean for benefiting society or individual people. But there's a big difference between a great company and a great investment. We want to have good investments, great investments, which means the price you pay matters, not just is it a good company that's growing or something like that. Price is a big factor, and when you're buying something that's very expensive, it doesn't matter if it's the best company in the world. If you pay too much, you can never get a positive return on that investment. And as I've talked about, you take any company you want. There is no scenario if you took every dollar that exists and that was the price to buy the best company in the world. There's no scenario it's actually going to be a good investment. You are sure to lose money if you took every dollar that exists to buy one company, because they just can't keep up with that price that you're going to pay. It's just never going to be worth it. So with all that, we are always looking, but that doesn't mean if we don't have it in the portfolio, we don't think it exists. AI is a great example. I think AI is going to change a lot of things depending how it actually is applied and how the technology changes. That doesn't mean we need to be loading up on NVIDIA.
I would say that is an understatement.
Right. So what else is on your mind, Gary?
Boy, I suppose inflation is one thing. We're all experiencing it. It's not fun, particularly if you're retired. And I can't get a promotion anymore. I can't promote myself anymore to raise my Social Security more than Uncle Sam wants to raise that. But I don't think anybody really knows at this point in time how much inflation is going to go up over the next year to 5 years. You got so many economists now, they're saying, well, we pretty much got it licked. It's going to keep coming down. Well, we certainly hope that it does. But one big thing that's happening is we have had some really great comparisons with what inflation is now over what it was a year ago in 2022 when it was really high. Well, now we're going to start seeing inflation numbers from a year ago that have come down a whole lot. And so that the next few months, we may very well see the inflation numbers start to go up again. Now, I don't think they'll go up a whole lot, and there's no guarantee on that. But I think some of what you're reading now about inflation is whipped and it's really looking good. may not look so good in the next few months. But I feel highly confident we're not going back to 8 or 9, 7, 8, 9%. But could it stay sticky at 4 to 5%? I think the odds are probably better that it will be like that than, going down to 3 or even to 2%, which I don't think is happening anytime soon. But Ben, I don't know what your thoughts are there.
Yeah, I think it's interesting. Inflation. You ask most economists, even going back before this most recent increase, we can all point to how to measure inflation, but different economists have different opinions on how it's actually how it happens and how to control it. And I think the policy decisions up to this point have obviously had an impact, but we don't know. The Fed doesn't know if they've done the right amount. They're doing the best they can, theoretically, but they are going to control inflation and then stop raising rates. And it could be too early. It could be too late. I think it is a very important thing that a lot of, if you're just, reading the headlines, you miss what you just described, which is when you have a lower base, if things aren't increasing as much, you have an increase. The math just means inflation can increase faster. What everyone needs to remember is even if we have inflation of 0%, which I don't think we're going to get there, as you said, anytime, maybe ever, that just means we're resetting at what the prices were last year. That doesn't mean we're going back to, pre-COVID levels of prices for things. And we've only seen the short-term impact on what that means for earnings and for the economy and for wages and everything else. But we have arguably a permanent reset to a higher level that everything's going to cost more. And I remember thinking, I was actually just talking to my wife, and we were kind of talking about right out of school, what we were earning. I've got a brother and sister who are just a couple years out of college, and so just kind of resetting expectations, talking to them about how much stuff cost. And I did the math, and it's crazy how, you said we've been working together for 13 years. If I go back to that point, when you compound inflation over that period of time, what wages were then for me versus now, everyone kind of remembers what things used to cost. And then you look at it now and you say, I can't believe I'm spending that much. That's just a permanent fact of having any sort of inflation is you increase the price, and it's always going to be there. We have a client, he recently passed away, but he was in his late 90s. And he remembered what it cost for things when he was in his 20s and 30s. And it was always a struggle of, I can't believe it cost this much. That's just a fact of inflation. So whether inflation's 2% or 4% or 6%, we've reset at a higher level. And it takes a while to get used to it. You maybe never do. But it does have impacts that continue on. And we will continue to see those impacts, whether inflation is under control, quote, or not.
Right. I think there are some things out there that are, that are not being counted in so much over the next year or two. I think, something that gets a lot of publicity is the actors and writers strike. And that's all about how much the actors and writers are getting paid for streaming. And apparently they really feel they're being shortchanged. The second thing that is much, much bigger, and that's the auto industry. And they have started their negotiations. And traditionally, to start off the negotiations, the auto industry executives and the union executives shake hands and say nice things about each other. And then they start the negotiations and, sling artillery at each other. Well, this year, the union, this was just a week ago or so, refused to even shake hands with the auto industry executives. And the head of the UAW has made it very clear they are going to be tough negotiators. They're ready for a strike. There's going to be big increases in auto workers' pay. That's going to hit everybody hard when you want to go out and buy a car. And that's just a couple of examples and why I'm not quite so optimistic and inflation just coming down as much as some people seem to think that it is.
Yeah, it's we all want to declare victory as soon as possible,
Yeah.
but that we I think if anything, just to caution, I think volatility in the markets is here to stay. We're going to continue to see it. Could be on the upside, could be on the downside, but the markets move a lot, and so even if you looked a month from now, there could be a big change in prices. If you watch this video a month later, there's going to be different returns, and that's just part of risk and part of the markets. Risk is both what you know is a risk, but it's also what you don't know that's a risk out there. And we recognize we can't predict the future. No one else can, in our opinion. And so it's probabilities and diversification and all those things. Before I let you go, Gary, any closing thoughts? Anything you want to make sure we finish with?
Well, I'll be happy when the temperature in Texas goes down below 100. That's my first thought. But those of you in Illinois or the Midwest, you're laughing right now. But my air conditioning does work.
Okay,
So
there you go.
quite pleased about that. And we hope that we won't need the air conditioner repairman to be on speed dial anytime soon. But we may get to know him a little bit better.
Hopefully not. Hopefully not. So
that's about it. Enjoyed talking with you again, and everybody out there. I haven't done this in a year. It's been somewhat chaotic with the move and getting everything settled here in Texas, but we've done that, and we're happy about the move because the reason that we did it was that my family has lived down here. We're in a suburb of Dallas called Euless, Texas. My sister, brother-in-law, niece and nephew all live in McKinney or Richardson, two more suburbs. And then our daughter and our 5 grandchildren live in Irving, Texas, which is about 15 minutes from us. So we're close to the grandkids now, and we love that. And we were sitting up in Chicago, and all these folks were down here, and we're saying, why are we sitting in Glenview when everybody's down in suburbs of Dallas? And we finally made the decision that this is what we wanted to do, irrespective of it being kind of warm in the summer. But I will tell you, in January, February, March, we will be very happy when we don't have snow to shovel and so on. So there's no perfect place to live for the weather. It doesn't exist.
That's right. Well, I think it's a good reminder. We talk about investments, we talk about the markets, and we're doing financial plans and all that, but all of it's about giving you the tools to do what really matters. And you moved. Yes, weather is a factor, but if your family wasn't there and they were all somewhere else, you probably would have moved there even if it was colder. And so what really matters is the relationships and the people you care about and the things you're able to do to enjoy your life. And that's what we're in this for too, is to help our clients get to that point. So let's not worry about the market so much. Well, that's our job, and go and live your life the way you want to.
Well, I guess I will put one caveat on that. Thank God the family's not in Edmonton or Fairbanks
that's fair.
or
That's fair.
Something like that. We'd probably still be in Chicago.
Fair enough. Sounds good. Well, Gary, thanks for joining us again, and we'll have you on in the future.
Very good. I enjoyed it very much. Take care, everybody.